Hey, welcome back to Level Traders YouTube channel. Today's video is all about hammer candlesticks and how you can trade them. Now, a hammer candlestick is a signal of a reversal. Here are a couple of examples. Now, the difference between the two is the tail. As you can see with the first example, this is a bullish hammer signaling a potential bottom in price. This is because there was a sharp reversal off the low with price being squeezed higher. The opposite can be said with the bearish hammer, where price reverses sharply off its highs, suggesting a top in place. Now, the color of the candlestick is less relevant because all the color of the candlestick represents is where price opened and closed. So for a candlestick to be green, price closed higher than where it opened. And for a red candlestick, price closed below its open. Now, the colors of these candlesticks could be the opposite, like this. It doesn't change the left hand side being bullish hammers and on the right hand side showing bearish hammers. The key is the direction of the squeeze in price. Price being squeezed higher points to a low being put in, with the opposite said for when price is faded lower. Let's now have a look at how this can be used in practice using the Nasdaq 100 from this week. So we've discussed what a hammer looks like, both bullish and bearish, but how do we turn that into a strategy? Well, with a set of rules. So a few rules that I utilize for trading hammer reversals. So the first rule, the size of the body of the hammer. How big is it? Second rule, does the low of the hammer hold in the following candlestick? And the third rule, is the high of the hammer taken out in the following candlestick? So here is a chart of the Nasdaq 100 from October to mid-Jan. So my first rule, how big should the body of the candle be to be classified as a hammer? 25%, 30%? My general rule is that the body should be no larger than 50% of the candlestick. Here's a few examples I've highlighted on the Nasdaq. Now, example 1 is approximately 50%. So the body of the candle is 50% of the whole candlestick. The second one is approximately 50%, give or take. Again, example 3, around 50%. And example 4, it's probably like 10%. So what does this tell us? Well, the smaller the body, the sharper the reversal, because you can see price reversing sharply off its lows, forming a long tail. Now, this is the tail I'm referring to. Now, what we've established is a rule for the body of the hammer. Let's now look at the other two rules. Does the low of the hammer hold in the following candlestick? Well, the answer is yes in all 4 examples. So a reversal is potentially on the cards. In terms of managing risk, a stop loss at the low of the hammer is probably a good spot should the market suddenly reverse and go against you. And the final rule, is the high of the hammer taken out in the following candlestick? This is what I use for entry. Well, you can see the answer is yes again in all 4 examples, though in the first example, the breakthrough actually comes in the second candle after the hammer. The trade still works as the stop isn't triggered, which is placed at the low of the hammer. The final example also includes another indicator like the 200-day moving average shown in this chart, which is why that reversal ended up being a sharp one. So now that we've gone through a live example, let's talk briefly about the pros and cons of hammer candlesticks. So what are the benefits of hammer candlesticks? Well, a hammer candlestick can be applied to any time frame. So this can be applied to a 10-minute chart, to a weekly or monthly chart. And it can be applied to any asset. As long as there's sufficient price history available, then candlestick charts can be used to identify reversals. However, there are some limitations with hammer candlesticks. This is a key limitation. The hammer candlestick doesn't give you a target or a take profit. You have to forecast using other metrics and tools to determine that potential target. Unlike, say, an inverse head and shoulders pattern, which gives you a target price, The hammer candlestick doesn't, which impacts your risk reward ratio calculation. Now those that are interested, you can see how to calculate the target of an inverse head and shoulders pattern in the video link that I've posted in the description box below. The other limitation is that hammer candlesticks can give you false moves or breaks if used in isolation. Now that last example of a hammer candlestick had more than one factor signaling a reversal. Let's go back and have a look. You can see here price tagging a moving average. This is the 200-day moving average, which is a significant indicator traders use to determine the longer term trend of an asset. The fact it triggered a major moving average increases the likelihood of a reversal, with it being a key support area. For those that want to know more about moving averages, check out my video on this in the description box below. Now, relying on one factor or indicator reduces the probability of a setup working out in your favor. So when you see more than one indicator or factor leading to the same setup, that is a setup we want to go for, because the probability of success increases when more factors line up. With that said, I hope you found this video useful. Remember to hit that subscribe button so you don't miss any future content, and I'll see you at the next one.